Mark your calendar for June 30th. Prices for the programs on Building Your Wealth, linked down below, will go up substantially with the release of new lectures free for existing course members. Check out those links down below or send me an email at staff@meetkevin.com. In my opinion, this congressional hearing was an absolute disgrace. This was the first time we've had a semi-annual report provided by Jerome Powell to Congress since before the banking crisis, and it appeared that pretty much every banker and Wall Street suit somehow managed to get in touch with their Congress member, or basically to provide them some form of script on exactly what they wanted, which is, of course, less regulation and finger pointing rather than like actual productivity here. That's really what a lot of this seemed to be. Now, there were some takeaways that are worth analyzing, and we'll do that. But I really just want to upfront say it really felt like a lot of these congressmen and women went up there and read their script from the Wall Street bankers and said things like, we don't need more regulation, Congress doesn't even know how to handle appliances, in reference to like stoves and stuff, and oh, I can't read that word right, so I'm going to mispronounce it. Like, it was really embarrassing. So it was 3 hours of listening to this stupid crap to get some small nuggets. So what were the small nuggets that we got from Powell, and why are markets not reacting very well? Pretty much, well, why haven't they? Basically all day long. With the exception of Bitcoin, but that's different. So, first of all, Jerome Powell made it clear that the SEP's projection of 1 to 2 rate hikes was more likely than not to come true. And that's one, in part because we don't know what kind of lags there are to monetary policy. We could always cut again if we need to. And that the economy is actually doing decently well. That is, we have this luxury of being able to say, hey, we've got too much labor tightness to where we could take a little bit from here and solve the inflation side of the dual mandate. And this is something that Jerome Powell really reiterated. It took quite a while, and again, 3 hours to get through it. But I think markets are reconciling Jerome Powell's reiteration of let's take from unemployment and solve the inflation issues by potentially raising rates a couple more times, up to a couple more times. At least one rate hike now being priced in at about a 79% chance for July. And then you're starting to see the pricing in only at about a 13% chance right now, but you're starting to see those 2 rate hikes priced in by September. I think markets are having problems today reconciling this with what just happened in California. California's unemployment rate, and this was announced today, rose to 4.5% in May, so for last month. That's up from 3.83% in August of 2022. And California is often, even though people hate on California, it's often seen as somewhat of a bellwether for national trends. And we haven't seen this kind of divergence between California's unemployment and the United States' unemployment level since the 1970s. And since Jerome Powell did reiterate, hey, since maybe the banking issues were indeed just individual mismanagement rather than a true problem of tighter Fed policy. In other words, if tight Fed policy was really driving banking failures, then maybe it's time to stop raising rates. But if that was really just individual management, then maybe we can keep raising rates because we have the liberty to do so now. That has also coincided with the 5-year break-even rate slightly ticking up to about 2.2% now. At least during testimony, it was sort of trending up again. And at the same time as California's unemployment data came out, markets started reconciling this idea of, okay, so 5-year break-evens are not falling even at, Fed rates being at 5%. You've got California's unemployment rate rising, which is a sign of potential impending hard landing, so to speak. At the same time as Jerome Powell is talking about higher rates, maybe it's time to take a little bit of a breather from the stock market rally. And that's kind of exactly what we saw, with the exception of Bitcoin, which has been trading sideways for about 3 months, had a great start to the year, but kind of sat out most of the stock market's rally since the banking crisis. Of course, since the meeting or since this testimony ended, we're now sitting with the NASDAQ down about 1.25% on the day. You've got chips selling off. You've got, for example, Intel down 5%, AMD's down 5.5%, NVIDIA's down 2%, Tesla's down 5%. So a lot of the growthy names, I mean, C3AI up 11%, although I've never been a big fan of that one. A lot of the growthy names seeing red. Apple only down about 0.5%, and Google sitting at about 2% down. So some give back of the rallying and excitement that we've seen over the last 3 months here. Starting really today, as maybe markets are starting to realize, okay, maybe we do need to get used to the idea that rates will have to continue to trend slightly higher. We do have generally good trends with inflation, but again, based on when we actually think the Federal Reserve is really going to cut rates, which is around a 5-year break-even rate of around 1.6%, and being stuck around 2.2, yeah, there is that likelihood we do need higher rates from the Fed. And so markets will have to price that in. Now, how much those higher rates will actually end up affecting anything, to be determined. This could entirely just be what we're seeing in markets now, a slight give back of just some of the rallying we've had over the last week, because really nothing terribly groundbreaking came out of this congressional meeting. Again, we heard some of the usual revisiting of, hey, if labor is tight, then that's going to slow down how quickly we can get down non-housing services, which are responsible for about a little more than half of core inflation, and that it'll take some pain there to actually bring that down, that inflation down. And we're seeing that now in California, but that's going to take some time again to get to the national level. And that's how you get the bearish narrative, which suggests, okay, well, by the time it gets to a national level, it's too late. Now you're in a recessionary environment. And so I think that's what markets are kind of like, okay, so recession or not? Like, if Powell's going to be a little more aggressive, does that mean we trend towards a recession, or can we avoid it? And this morning we were looking at some GDP figures and comparing that with what's going on with housing data, which could suggest that housing data alone and residential fixed investment could actually pull us out of a recession before we even go into one, which would be great for avoiding a recession. That's the biggest fear of markets. Really, I think today is more of just a give back than a reaction to anything in particular that Jerome Powell said, other than probably the biggest item is that his indication is, look, if the economy keeps going the way it is, maybe the summary of economic projections will be accurate. Before the meeting this morning, I had suggested something that you would want to hope for would be some kind of distancing from the summary of economic projections. We didn't get that this time. In fact, if anything, what we got was a Powell that reiterated the summary of economic projections, which is actually the opposite of what he did last week during the Federal Open Market Committee presser. During the presser, he distanced himself from the summary of economic projections, saying, everybody kind of submits their estimate, and they do that from their offices around the country, and I don't really know much about him. Distanced himself. Today, he actually reiterated it by reiterating, hey, look, 16 out of the 18 members are projecting another rate hike. Quite a few of them even projecting 2 more rate hikes. But again, I think this is where we have to evaluate how much should markets really care about an additional 25 basis points here or 25 basis points there. If anything, another 25 basis point hike reiterates the belief that the economy should be strong enough to withstand it, and earnings should be strong enough to absorb another rate hike, to actually to some extent potentially be good news. So I don't know that we really got any clarity that we were hopefully looking for out of today's congressional testimony. Listening to every word of it for 3 hours, and a lot of it being very frustrating, actually trying to kind of sift through all the noise and just pick out what was actually relevant to the markets. I can only say that the takeaway is that, hey, Powell's ready for another hike or two. And that's going to lead to some kind of breather here in rally mode. If we just now accept that, and then after this testimony ends tomorrow, we just go right back to rally mode by Thursday, Friday, and then into next week as the first half of the year closes out, entirely possible. However, your next big catalysts coming up is something to consider: earnings cycle. As we close out the first half of the year, we are going to go into Q2 earnings. So as soon as this testimony ends, we'll have about a week of somewhat quiet, And then we're right into Q2 earnings. And so those will be very, very closely watched, especially with the new valuations that we have now for a lot of companies. Much higher than what we had for Q1 earnings. So anyway, there you have what happened here. Do remember that we've got a lot of lectures coming out for the courses on building your wealth at the end of this month as well, and that's when we'll have a single larger expiration and price increase for those programs on June 30th. If you have questions for bundling up, send me an email at kevin@meetkevin.com. And that does it. Thanks so much for being here. We'll see you in the next one. Goodbye. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by